Hello, everyone, and welcome to my YouTube channel. What a great opportunity I have today to talk with somebody that all of you must follow, Mish Shedlock. He is investment advisor at Sitka Pacific Capital, sorry. And he's one of those people that has not just one of those blogs that always make you think, but a blog that actually makes you understand why it is so important to truly analyze the global economy in detail. Hi, Mish, how are you?
It's a pleasure to be on the show, and let me say, I followed you for a number of years. It's great to be talking with someone who understands that Austrian economics is something about other than the country of Austria. So it'll be good to get down into the details of what's wrong with Keynesian, what's wrong with the monetarism of the Fed, of the Bank of Japan, all these places. I'm sure that's on your mind as well.
Absolutely, it is. Actually, we're going to start with a bang, no? Which is, let's explain to people, Mish, why uh, just the endlessly entering into stimulus packages and endlessly increasing government spending is not good for the economy, because the rhetoric right now that you probably hear quite constantly is that, well, if a stimulus package doesn't work, it's because A, it wasn't enough, B, we have to repeat. So let's start by that fundamental question. Why is that not the case?
How many times do we have to prove that short-term stimulus always wears out? Look at Japan over the course of what, 3 decades now, or is it four? I'm
It's in
almost
the
losing
fourth
track here.
decade. Fourth decade.
Of stimulus after stimulus, of building bridge, of promoting stuff, and then their last not brilliant idea was well, let's have stimulus combined with tax increases. Say what? So we're going to have unproductive investment and we're going to raise taxes. How well do you think that worked? It didn't. And if you look at the Fed, I mean, the Fed statement yesterday was really nauseating to me. The no mention of tapering at all of its QE's policies in the statement. They discussed it offline, and actually they said they were discussing it, something like that, but it wasn't in the statement. They said they were going to continue this. All they've done is drive up asset prices, okay? And at the backside of every asset boom is an asset bust. And I don't know why they can't figure this out, but we're in our third major bubble in just over 20 years, right? So here we are. And then the statement yesterday was they're going to continue QE until they get above 2% inflation for a substantial period of time, allegedly to make up for past underinflation. Well, they don't count housing in the CPI. They underweight medical expenses in the CPI. People on Medicare who who get health care for cheap, that doesn't count as a CPI. Housing prices aren't in the CPI. So all the things they don't count, what is it they're measuring? They need to be measuring or looking at inflation, not what they believe to be consumer inflation, and then getting it wrong on top of it. So, meanwhile, debt builds up and up and up and up, and there's interest that has to be paid on that debt, right?
Yeah.
All of this stuff is a slowdown on the economy, Daniel. It's clear. Question is, how do they not see it? Or do they see it? That's my question I keep asking. Are they this dense, or is there something else going on?
That is a great question. And one of the things that I find fascinating about my experience, because I've had the opportunity of meeting or working relatively close to ex-chairman of central banks, is that they actually see it crystal clear when they're outside of the central bank.
Oh, yeah.
Yeah, I've had the opportunity of discussing this with people that have been working in central banks in the past, and even, for example, you see now Draghi saying it very, very clearly. But I think that the perverse incentive of kicking the ball further and just extending and pretending, with the idea that if valuations are elevated, that is sort of an acceptable second sort of degree consequence of monetary policy, then and obviously tinkering with the way in which inflation is calculated, as you very well mentioned just a couple of minutes ago, is something that ends up generating these perverse incentives that we mentioned before. And I think that the problem at the end, and you probably can shed some light as well on this, is that they can't do anything else because they're trapped, because they did not realize that once you open the Pandora box of quantitative easing and monetization of government spending, sky's the limit. Governments don't reduce deficits in periods of growth, and and markets behave, as we are seeing right now, in a way in which they basically demand more stimulus in growth or in recession periods. How do you see that?
This all goes back to what, right? This goes back to, I forget the exact date, sometime in 1971, I think it was August of 71, when Nixon, closed redeemability of gold. And governments quickly, within a few years, figured out they could, inflate at will without having any payback.
Yeah.
Prior to that time, prior to Nixon doing that, if countries ran deficits spending like they did, they either had to raise taxes to pay for it, or they lost their gold. France was taking just mountains of gold out of the US. Nixon didn't want to raise taxes. He wanted his, what I believe they call the guns and butter policy right now, of supporting, of having free, cheap money and having a war at the same time without paying for it. So now every country on the planet has learned that they don't have to be fiscally responsible because there's no consequence of their actions. They're not losing their gold. It was the last enforcement mechanism we had on policies. Now, these policies, of course, come from not from central banks, but come from the government. That's what kicked this off, right, Nixon? But central banks are there, to support it, and then some.
Yeah.
So it's a very, very bad mix. And on top of that bad mix, we've got bad demographics on top of it. Japan got hit first. Europe is far worse than the United States, but the United States is there too. We have, I did a report last week, Daniel. I was trying to figure out what's going on. Why are these wages going up? Why is there so much demand for labor that people can't get? 5 million people aged 60 to 64 in the last year just said, I'm not working anymore. Now, these were very skilled people on average, right? Age 60 to 64. We have millions more coming. But that's one force. And people look at this, and the Keynesians look at it, the monitors look at it, my gosh, look at this. This is providing an upward pressure on wages. Look out, this is going to happen. And we can see it. There is upward pressure on wages. However, look at the demographic purchasing power of millions of people and millions more to come who are retired, generally spend less in retirement. They don't have that income coming in. They're on Social Security or something else. Got a huge force here, Daniel, that's the opposite direction. People only look at one side of the coin. There's two sides of the coin here with all of these people rising and a short-term push-up in wages as a result.
You bet. I think that one of the biggest flaws of Keynesian consensus economics is precisely willingly ignoring demographics in their analysis of the economy, because you look at, you mentioned the Eurozone, about 20% of the population is going to be 65 years or older in very little time. The situation in Japan is even worse because it's not just aging but shrinking population, no? But central planners simply ignore demographics, simply ignore the big impact on consumption, on the impact on purchasing power of wages, the impact on so many different levels that that show that so many of those stimulus packages fail precisely because they don't look at that important driver. But you just mentioned the impact of wage pressure. What do you think are the main areas that I would say concern you, or at least give you the warning sign about the U.S. economy right now? Because everybody's looking at it, particularly in the rest of the world, as some sort of example of everything going well. No?
Look at the last 2 days of bond yields. My gosh, you know what, the 30-year was down another 9 basis points today, was flat yesterday, whereas other portions of the yield curve at the low end, the 2 end, 5-year rising, long end coming down, got a very flattening of the yield curve here. You know, that's a signal here right now that something's wrong, that all this implied growth that people are expecting for the fourth quarter and for next year. You know, I'm not sure when exactly the slowdown starts, but by fourth quarter wouldn't surprise me at all. And I would say, I would bet on by the first quarter, as the stimulus wears out, and as you know, the Fed gets in this tightening cycle. They always get in these tightening cycles at the very last minute, right? And then from 2010 to 2014, they could have been normalizing interest rate policy.
Absolutely. Yeah.
No, they waited and waited and waited and waited until a year later they have to reverse it all. It's the biggest asymmetric policy in history. But the thing that disturbs me most, I never answered your question, is Powell's statement yesterday. You know, keeping inflation above trend. Who does that punish? This is financial repression. It punishes those who are retired on fixed income. It punishes the poor. It benefits those that have first access to money. That's the wealthy, the politically well-connected, and the banks. It's the exact opposite of what they should be doing. It's very aggravating to me. And today, you know, the last couple of days, and even for the last month, you've seen the yield on the long bonds stall. That's your signal here right now that the economy is slowing.
That is very important, because a lot of people look at the massive stimulus packages. They say, wow, you know, multiplier effect never happens. Never happens. You know, look at how little effect on the economy, on the potential growth of the economy, the succession of $1 trillion stimulus have, no? And we're looking at, we were talking about it here today on television about the European Recovery Fund, no? And I said, everybody seems to have forgotten about the Juncker plan. The Juncker plan was 500 billion euro of stimulus package that created zero improvement on the economy and zero improvement on jobs. And what everybody's doing is simply saying, well, let's forget about that. Let's talk about this new thing, no? And you just mentioned that, is that the slowdown is much faster and is nearer than what people perceive. People think that you were going to see 2022 with 6% growth, 2023 with 4% growth, 2024 with 2% growth. No, it's
not going to happen. I certainly agree with you. Let's fill in a piece of the puzzle here for people in the U.S. who might not recognize the name. You're talking about Jean-Claude Juncker, who was the European Commission president, who kept pushing for more Europe, more spending, more of this, a fiscal union, so that essentially they could rob from Germany to support Italy. None of this stuff works. The Eurozone itself is broken because of productivity differences between Germany and Greece and Spain and Ireland. There is no one interest rate policy that could possibly benefit all of these countries that have little in common other than the great idea of freedom of travel, which I embrace. I mean, outside of people from Africa and the Mideast moving in millions of numbers, but freedom to move around in Europe is a great idea. It's very similar to crossing the border from Illinois into Indiana every day. But that's a great construct. But merging of debts, when you have countries at varying differences of productivity, of demographics, of work ideas, it doesn't work. So, one size fits Europe doesn't work. In practice, it's been one size fits Germany, and which has caused all these malinvestments in the peripheral states.
Absolutely, because that's the concept of malinvestment tends to be missed by many people. No, and when people ask me, what's the problem? If they spend in a project or in a construction project that is not necessarily something important, but at least it's there. No, and people tend to forget that there's a flip side, and the flip side is, you mentioned before, lower real wages in the future, lower purchasing power of your savings, weaker productivity growth, which means weaker job creation in recovery periods, and much higher debt, which means much higher taxes in the future. So people tend to forget the flip side of let's spend and who cares, no?
Right, and this gets to the heart of MMT, modern monetary theory. There's nothing modern really about it. Someone put a catchy phrase to MMT, right? Isn't that what's going on here? It's just spend, it doesn't matter. This whole idea that prices don't matter, that is the essential fundamental point of MMT. And the second one is that governments can spend money wisely. So, to them, all of this spending is savings. And people keep talking. This is one of the things that really irks me. And some people who I think are even bright, really understand, the global trade picture and thing, still believe that there's this big pool of excess savings here. Savings, let's not confuse printing money and wasting it with saving. Sure, the wealthy, their bank account's gone up, but is that saving? If I write myself an IOU and stick it in the bank, is that saving? In the Austrian economic world, savings is production minus consumption, right? I produce 5 barrels of wheat. I eat one and I sell the other 4. Well, those 4 that I sell for money, that money represents the excess production that I had. That's the true savings here in the economy. When the Fed or governments just hand out free money, there is no real pool of savings behind it. Certainly, we've got this buildup, a massive buildup of wealth inequality, and it's the Fed and governments that are doing it. And they're wondering, and you hear Janet Yellen when she was head of the Fed, she was constantly moaning about the wealth inequality that the Fed and governments were creating by loosey-goosey monetary policy and QE that benefited the wealthy at the expense of the poor and those on fixed income. That's the big piece of the puzzle, I think, that some very, very bright people who otherwise get this are wrong. They don't understand the concept of what savings really is.
Yeah, I think that it infuriates me when I hear that the global economy and that the Eurozone and the United States are going to thrive in 2021, 2022 because the excess savings are going to be consumed. What are you talking about? It's just complete and absolute nonsense. To start with, the whole idea that you put together the calculation of savings, which is wrong, as you very well mentioned now. But you put together that calculation of savings and you say, oh, there's an excess of savings. Says what? Says who? Because if I have 20% of the working population in furloughed jobs, as you have in some countries in the Eurozone, I tell you that people are not saving because they're hoping to get a bargain on a next trip to Vegas. Is because they fear that they will not have anything to eat in the next 6 months, no? But the other point is that it's not excess savings either, because if you take it always eliminates out of the equation the massive amount of debt attached to each of the individuals that come into the calculation. So I think it's pure nonsense, and that it also brings the problem of the multiplier effect is that we have this illusion of multiplier effects of spending and stimulus in the economy that obviously is not just that they're not happening as they happened in the past, is that they are starting to show negative multiplier effects in numerous economies.
Yeah, I mean, how many times do we have to disprove this money multiplier theory? Look, we've had massive stimulus, massive, 3 rounds of stimulus. 1 under Trump, 2 under Biden here now. Guess what? Did you see the last retail sales numbers? You know, they were down, and economists were surprised. Surprised, my God, shocked that spending is falling off already. Guess what? The stimulus lasts about a quarter. If they're lucky and they spread it out, maybe it's 2 quarters. That's it. And then, what are they going to do for an encore? And meanwhile, I mean, and the Fed, it was QE. They're doing this whole thing is so screwy that if you explain this to the average person, they would say, "What?" The Fed is buying. What was their number? $120 billion a month in supplying banks with money. Banks can't even use that money. There's a dearth of corporations that want to borrow because they don't want to invest. Why do you want to invest in this environment here with all this stuff going on? They don't. The Fed's cramming all this money down their throats anyway. And guess what? People don't understand this, but cash is actually a liability to banks, and the asset to banks is whatever loans they do. And the system is so screwy that on this cash, the banks actually have to raise capital. So they're telling the Fed, no more QE, no more QE. We don't want it. We're choking on it. And so the Fed, in response, is doing reverse repos. And that's a repo, which is QE, which is that monetary push of money to the banks. The banks are choking on it. So they're doing what? $500 billion a day, rolling it over every day in reverse repos. So here, on one hand, they're saying they're going to continue this QE, But on the other hand, they're taking it back because banks are actually choking on the money and actually have to start raising capital because they're paying more on deposits than they're getting for parking the money at the Fed. The whole situation is so screwy. I actually thought, foolishly, that the Fed might come out and issue some sort of statement on this. No, the statement was they're going to continue doing this.
Yeah.
And last week, Powell said the system has worked as designed. Well, here, I'm shoving trillions of dollars of money your way, and you're shoving trillions of dollars back at me because you can't use it. And this is working as designed.
Wow. It's amazing, because people don't understand that what you have just beautifully explained about the reverse repo. They look at that and they hear that and they say, I don't understand what this is. And obviously nobody's explaining it to me, because it basically shows that the quantitative easing, the massive liquidity injection, is having to come back because
yes.
Yeah, absolutely. I remember when the European Central Bank came with its analysis of the success of its QE, and I remember pushing the chart of excess liquidity at the European Central Bank, 2 trillion euros, which shows again that there's this absolute nonsense idea that you push liquidity into the system that is going to generate higher demand, and that demand is going to create a multiplier effect and come back as higher growth and higher employment, which doesn't happen. But the most interesting thing that you mentioned as well is that at the same time, everybody understands, or at least they perceive, that the wealthy are getting wealthier, that money creation is never neutral, and it disproportionately benefits the first recipients of money, the indebted and governments, and disproportionately affects the real wages and salaries and savings of the people that hold cash. But instead of saying, okay, quantitative easing is a policy that is generating inequality, what they say is, hey, the Fed doesn't do fiscal policy. Governments should use fiscal policy to reduce inequality. Second, they come up with the nonsense of as you very well said, the not so modern monetary theory, which is, okay, if it doesn't work to do quantitative easing, let's print directly so that we go full Argentina style. Isn't it amazing that the problem is the solution to the problem is a bigger problem?
Yeah, that's the big thing here, and what people miss about all this QE, and they talk about it adding to money supplies, and certainly if you look at M1 figures, okay, M1 is soaring. It's in direct response here that QE and M1 money supply actually go hand in hand, and and they have. And people look at this as if it's real money. Yeah. It's not real money that anyone can spend. And banks don't lend from these deposits in the first place. That's another misconception. Banks lend whenever they feel they've got, and they might be wrong, but whenever they think they've got credit-worthy borrowers who want to borrow money. But if you look at commercial industrial loans, if you look at total loans and leases, actually, there was a brief jump for after the first round of stimulus, but loans and leases and commercial and industrial loans have actually gone down over the last year. And so, and we Mario Draghi was bragging about the success of QE in Europe. Where was it? How did it stimulate lending? It didn't stimulate lending over there, and it didn't stimulate lending over here, and it didn't stimulate lending in Japan. So where's the success, Daniel? Where's the success?
Obviously there's none, because they need to repeat it and they need to prolong it, because if not, the whole thing crumbles. But this point that you just made is something that people do understand, is that you can bring a horse to water, but you cannot force it to drink. And when businesses are not finding opportunities to invest, when families cannot borrow anymore, you can push liquidity all you want and you can bring rates down all you want, that you're not going to see higher credit growth. And as the policy that you implement disproportionately benefits the already indebted, governments, corporations, etc., you perpetuate overcapacity. The other day, I was looking at industrial production figures in the United States. Everybody's like, oh, in capacity utilization rose to 75%, rose to 75%. That's 25% overcapacity. And that you perpetuate overcapacity. Therefore, credit growth is not going to rise as expected by the central planners. And then they blame businesses and families for not taking enough credit, and they have to massively increase and prolong the policy, because as none of the things that they aim to stimulate actually get stimulated the way that they expect, then it is impossible to justify the elevated valuations of bond yields and equities. Therefore, they need to continue the policy in order to sustain the markets, which is insane.
One of the side effects of the Fed lowering interest rates and forcing down interest rates via QE is that it's keeping zombie corporations alive. Why would a business want to expand when they've got to compete with these zombies that have no reason for even existing at all?
Yeah,
it's totally unproductive use of money. It's burning of capital. It's a waste, and the Fed and central banks and Europe's even worse with negative interest rate policy of keeping these zombie corporations alive. And it's crazy. It's counterproductive. Yet they just refuse to see it. Now, one of the interesting things is, and you mentioned earlier, once outside the role, they can see it. They can also see some things looking outside their own country. For example, Bernanke, when Japan was going through its huge rounds of deflation, Bernanke said to the Bank of Japan, just write it off, write it off. That was the correct policy, right? What did he do? The moment he had the chance to essentially, let the banks be punished for the lending mistakes they made. No, he did exactly the same thing as Japan did. We can see the Fed somehow at least can see that the negative interest rate policies of Europe didn't work. So we're not going to go down that path, I don't think. But they can't see their own mistakes that they're making, even when they chastise others and say, don't do that, don't do that, don't do that. When it's their turn, the US is following Japan.
That is a great point, actually, because it is true that they tend to make interesting comments about other countries that then are later forgotten inside, in their own countries. You've just mentioned about negative rates, and there are some thoughts out there whether the United States has or will go down the negative rate route. Do you think that? What is your view of the link between moving into negative rates and having a risk to the dollar being the world reserve currency? Do you think that is interlinked?
I don't think those are interlinked. Okay. But
I agree,
when it comes to negative rates, one difference between the Fed and the Bank of Japan, excuse me, the Fed and the ECB, is that negative rates are really a huge tax on banks.
Yeah.
And so the Fed is far more beholden to the banks than the ECB is to the European banks. And in fact, I was wondering once, and who knows, off the cuff of my head theory, this is so bad for the banks. And look who was president, Mario Draghi, from Italy, who wants bailouts and a union, one of the biggest countries, screaming for commingling of debt, and at times even Italian politicians threatening to leave the Eurozone over it. In the back of my mind is the possibility that some of this was on purpose by Mario Draghi to create a crisis, to force this political union that everyone there is angling for. I don't know. I tend not to believe conspiracy theories, especially my own, but I'll throw that out there because what they've done is so obviously counterproductive and non-beneficial to the banks. Whereas if you look at the policies of the Fed, in a way, it's opposite.
Yeah.
Now, they make mistakes, and the Fed is making mistakes. I don't believe they're helping the banks here at all, but I don't think they'll take that final push and punish the banks like they did in Europe. I mean, it's the exact opposite here. We pay interest on excess reserves here, right? But and the ECB is charging banks for the benefit of having the cash that the ECB, like the Fed, has crammed down the throats of the banks.
Absolutely. Well, I think that it's not a conspiracy theory. I think that in the previous crisis, there was a consensus view among politicians and mainstream economists in the Eurozone that the problem of the Eurozone was simply that banks refused to lend, no? Like that, yeah? As if they're evil, no? They don't like to lend. It's their business and they make money on it, but hey. So but it's so simplistic and so ridiculous, but it's true that there was this sort of idea, no, that
the idea that banks were hoarding cash.
That banks were like, you remember the Uncle Scrooge cartoons in which
yes, I do. I used to read those as a kid.
Exactly. Yeah, I think that many people, in fact, actually have had that discussion in a few media appearances. Is that people actually believe that banks were hoarding cash instead of lending to the real economy, and there was this generalized and actually repeated over and over message that banks were not, that credit was not flowing to the real economy, as if banks were sort of stopping it. No way. They were desperate actually to get anybody that didn't that wasn't involved in real estate to lend to. I think that did trigger the view that negative interest rates would be not just something that would significantly support the deficit spending programs of almost every, if not every, Eurozone economy, but at the same time sort of punish the banks for being evil and not lending. And it obviously destroyed their balance sheet, their P&Ls, no, and their return on tangible equity.
Yeah, I mean, this whole notion that banks lend from deposits is just so screwy. Banks lend when, as I mentioned earlier, if they've got a creditworthy borrower that wants to borrow money, providing the bank is not capital impaired. If the bank's capital impaired, they can't do loans either. Time and time again, I mean, we've proven this. I mean, this whole theory of that, this is another sort of money multiplier theory that, the Fed injects this money and it gets lent out, and then that gets redeposited and lent out, and it gets redeposited and lent out, and on and on and on and on and so forth. The plain fact of the matter, the whole thing breaks down because banks don't lend for deposits. They lend whenever they feel they have a credit-worthy borrower. Now they make mistakes, and they made huge mistakes in the housing bubble years. And it's not that they knew darn well that that they were lending to people who couldn't pay back these home loans. They made them anyway because they figured that this was their big mistake, and I've never heard anyone discuss this, is that they felt that the price of the assets, that home prices would keep going up and up and up. Even if the person couldn't pay back the loan, they would repossess that house then. So what? Screw the customer. They've got this house that's appreciated in value if the guy walks away. Well, guess what? People walked away and the price crashed. That was the mistake that banks made. So, they believed that they either had a creditworthy borrower or that the price of the asset would keep rising up and bail them out. And they were wrong twice. That's what happened in the housing bubble. And it's, and this idea that the ECB is supporting lending with negative rates, that's actually a tax on banks. It's draining capital from the European banks. It's making them less, not more likely to lend.
Absolutely, absolutely. This is what's impossible to explain to politicians, is that you are making it so unprofitable to lend and so risky at the same time that, and it's interesting because at the same time, regulation is demanding the banks to increase their core capital. So on the one hand, you're penalizing them and forcing them to lend at higher risk with lower returns, very poor return on tangible equity, and at the same time you demand more capital. So you're asking basically you're asking them to drink and sing at the same time. No, but that goes to the point. Coming back to the point of modern monetary theory and everything that is being presented right now as sort of what I call upside down economics, no, is that borrowing and deficits create savings. I just cannot even start to believe that anybody that is mildly serious can believe that deficits create savings.
Now, I mean, there's the classic theory that you can't argue with, that savings equal investment. Well, that's fine, but printing out money and giving it away for free is neither savings nor investment. Exactly. And the thing is, I've not figured out how to account for that. So, I mean, we can see, that bank deposits are up, but what we can't ascertain very easily is what the pool of real savings is, because it is so distorted by central bank policy everywhere that it just goes back to the wrong definition or idea that we have this this massive amount of savings that's ready to be unleashed. And if you look at the MMT theory, which I was just looking at the other day, is that the more government spending there is, the more savings there are.
Yeah.
That's here. Let me give you an example here. So in MMT theory, if they spend, let's say, $100 million to build a bridge, you have $100 million in increased savings, right? Now, if they, for that same bridge, they spend $1 trillion, all of a sudden we have $1 trillion more in savings that can be respent. There's no price point. There's, the bigger the waste, the more the saving.
Yeah.
That's a fundamental tenet of MMT. I don't believe I've heard anyone discuss, but there it is.
Yeah, it is. It is absolutely, and the idea, and that's and that in itself is as an upside down economics and complete nonsense. But then there's the other part, which is okay. If there is excess money, then what will happen is that because supply of money grows, demand for money will grow in tandem. Where on earth did they get that demand and supply of money grow in tandem? That makes absolutely no sense, because that's the only way in which they say that their lunacy flat earth theory is going to avoid inflationary pressures. No, even more interesting as you read the things that they write is, first, you massively increase the size of government on the way in because it spends all at once. Second, if inflation goes through the roof, you tax the productive economy to reduce the excess money. So you increase the size of government on the way out. It's fantastic. It's just absolute lunacy.
It is. MMT's not really new. It's just a new word for free money supplied from government that has never once in history worked out well. And that's really the bottom line.
That's the point. That's the point, that again, it's been used numerous times in history. The assignats in the French Revolution, when Nero decided to add a little bit more of take a little bit of silver and put a little bit of different metals in the coins. I mean, it's been going on forever. So I think it's nothing new there. The point that I think is interesting here is, okay, so people say, let's imagine that Mish and Daniel are right and that what they're saying makes sense because we sort of more or less agree with it. Now, so far, everything continues to go reasonably well. Second, when does it start to show a breaking point?
Well, we've seen 3 breaking points now, right?
Good point.
In the dot-com bubble bust, the housing bubble bust, and in 20 years, well, we've not seen this one yet because we've not seen the bust yet, but it's coming. The third big bubble in 20 years. So one of the things that the Fed has achieved in its alleged stability is the propensity to blow bubbles and have them burst in amplitudes that increasingly get higher and higher and higher. So I've certainly been wrong about when I thought this would matter. I've been wrong for years.
Yeah.
When I thought this would matter, Daniel. And
Same here.
I've kind of got a saying, well, admit your mistakes or someone else is going to admit them for you. But I long ago thought that we would never, have another bubble this big, but they keep blowing and blowing and blowing. And there's no predicting when they will end. Certainly the dot-com bubble went well beyond what people who recognized it, and some people got wiped out betting against it in 1998. And there was a bubble in 1998, but it didn't pop until March of 2000. And even then there were a number of rallies where one could have gotten out. And the same thing now here. I never imagined that QE would have had this amount of effect for this long on the stock market.
Yeah.
But it has. Now, in a sense, it was a lot easier to predict when the housing bubble was going to crash. You could see it. It was based on stuff tangible. All of a sudden, we went from people standing in line, wrapped around the corner for the right to enter a lottery to buy a Florida condo. That's how crazy it got.
Yeah.
To the next day, the lines are gone. It's a little bit different now when it's involved in cryptocurrencies, Dogecoin, the chasing of housing again, but you know, in the Reddit traders,
Yeah.
propelling companies that are worthless to insane heights, wiping out hedge funds in the process. You know, but every time, Daniel, I think this is it. It hasn't been. I've been wrong. It keeps getting crazier and crazier. So I don't know. I don't know when it matters. I wish I could tell you when it matters.
I think that is what's important. The big lesson about that is the fact that it hasn't burst yet doesn't mean that it's not a bubble. I think that is the key factor. No, and understanding that a bubble means that when the price of assets has massively surpassed its underlying value and the real demand for it. But think about this. Anyone can understand. I mean, right now, it's been about 4 months that Greek bonds are yielding negative. Huh? Great. Okay. Everybody understand. Just make that question to anyone. Would you buy Greek 4-year, 2-year bonds at negative rates if the ECB wasn't buying 100% of net issuances in the secondary market? Everyone will tell you no. Well, that is a bubble. That is a bubble, because the next question is not where they are today, negative yielding. Now, is where would you even fathom the idea of buying 2 or 4-year Greek bonds? And when I'm saying Greek, I'm saying Italy or Spain or Portugal or France itself. When would you start thinking? You might be starting to think about it 2 times, 3 times a higher yield than where they are today. That is a bubble. No, and I think that what people fail to see, or at least understand, is that we now have a generation of young people that are chained in financial crisis. They are seeing one after another, and they simply just, it's not even, is that financial crisis become more frequent, even if they are not as aggressive in terms of the period that they last. No,
the message is that the central bank is always going to be there to bail them out.
Yeah.
At some point, that stopped working for Japan. At what point does that stop working for the US? Yeah. I don't know. We're long into where, you know, I thought that some of this stuff would matter. But yeah, without a doubt has distorted, you know, completely removed any free market pricing mechanism on most assets. Yeah. On bonds, on most assets. And if you look at, but just to understand why people are speculating, real interest rates are, well, let me see, something like, well, the Fed's holding money at 0, and the 3-month rate is 0, and year-over-year inflation's on the CPI is 5%. So we have real interest rates of -5%. Okay, people are being paid to speculate. Now, I maintain that real interest rates are even more negative because they don't include housing. So yeah, if you include the Case-Shiller home price index as a measure of inflation and substitute that for what the Fed calls owner's equivalent rent, which is what a house would rent for if someone who owned their own house would rent it. I mean, that's a pretty bizarre construct if you ask me, but that's how they measure OER, that at 24%, that is the largest component of the CPI. It does not include housing. If you included the housing components in the CPI, you would see that real interest rates are -7, -8%, perhaps. I've not calculated them recently. I need to go back and double check that number after we've got the latest CPI numbers. It's stunning. And so when that, there's no productive use of this money. Corporations aren't lending, aren't borrowing, as we just discussed. So, this money's going to go somewhere, right?
Yeah.
And it's going into asset prices. And the Fed, no central banks count those in their measure of inflation. Now they say, okay, Mish, you're wrong. Houses aren't a consumer item. Okay, so what? So what?
Exactly.
What is it we're measuring? Should we be measuring inflation, or should we be measuring someone's perverted notion of what consumer inflation is, because it doesn't count, Medicare, and it doesn't count business buying, insurances for people who have those policies. All those things are underweighted. I think we need a measure of inflation that really looks at prices, not just some prices, and artificially keeps, the CPI down. So people ask me, Mish, inflation is way greater than you think it is. Well, they don't know. They clearly don't know what I think, because I think home prices ought to be in there, which means that inflation is way greater now than where it should be.
Yeah.
But I think the important question, and somehow we've avoided it here, Daniel, is where to from here. The great debate now, what everyone's discussing, is whether or not this inflation is transitory or not. I happen to agree with the Fed that it's transitory for different reasons. They're screwing the economy. There's going to be a payback later on. The fiscal stimulus and the monetary stimulus is going to wear off. At some point, there's going to be this bubble that we're in, and it's a huge one, is going to burst. And when that happens, it's going to be anything but inflationary.
That's
but the vast, overwhelming majority of people, there's just a handful of us, and I'm not sure where you stand, but Lacey Hunt, David Rosenberg, myself, we're more or less believers in the transitory theory.
Yeah.
But we also look and say, well, guess what? Inflation's way higher because it's mismeasured.
Yeah. Well, I where I stand basically is, first, the problem of miscalculation of inflation and lack of understanding of the real cost of living existed before COVID-19. We had protests against the rising cost of living in France every week, in Germany and Chile.
Oh, the yellow vest movement, yes.
Yeah, you name it, all over the place. In Latin America, you name it, numerous places. So the first point is, yes, is that inflation was already higher than what officials showed when they were talking about no inflation. But the point that you're making right now is super important. And I think that my point, what I think is that, yes, is that the United States is going to see the same process that the Eurozone saw after the implementation of the euro. With the implementation of the euro, you saw inflation going 3-4%, blah, 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 but that massive chain of stimuli that generated overcapacity and weakened the economy generated a disinflationary process significantly afterwards. What I believe is that if it is, as you mentioned before, which I actually thinking about it makes absolute sense. If it's so short term and it makes so little impact and it lasts for a quarter, then it's not going to be transitory. It's going to be a blip, no?
Yes, but what the Fed gets wrong in their message is it's transitory. It's transitory. Yeah, okay, it's transitory, but they've also undercounted it. they've undercounted the mistake that they've made, and there's going to be an equal return on the downside when that kicks in.
Yeah.
You know, the Bank of International Settlements, the BIS,
Yeah.
you know, has done the studies of deflation.
Yeah.
And they've concluded that deflation is, and we're talking about here, simple, you know, monetary price deflation,
Sure.
not asset bubble deflation. But, you know, and they looked at both, and that simple price deflation was a benefit, and it has to be a benefit.
Yeah.
Because it's what you're saying is the cost of goods is cheaper. More people can afford them. You have increasing standards of living when prices go down. Yet the Fed is hell bent. Central banks in general, ECB, Bank of Japan, all of them are hell bent on forcing prices up.
Yeah.
Lower prices. It's asset bubbles. It's asset deflation.
Yeah.
That is extremely damaging. And we saw it in 2000. We saw it again in 2007 to 2000, early 2010. We saw asset deflation, very damaging to the banks. So by promoting price instability, promoting inflation of prices, which they can't do because their monetary policy is all going into assets, not prices anyway. You know, they're setting themselves up for this third very deflationary stock market bust when it happens, and it's going to happen at a very bad time when all these people who have been retired that we've talked about think they've got savings as measured by their wealth in the stock market. Guess what is going to happen when that bubble bursts and the stock market goes down and people don't have as much money saved up for retirement as they thought they needed? You can blame that when it happens on the Fed once again.
That's a very important point, because people are taking a level of risk that I saw I actually published the chart of the rising in ETFs on the stock market and the inflows into passive investment, and how retail investors are jumping on the bandwagon precisely at all-time highs. No, and the point that you made, I remember this Uber driver that told me in Miami, actually. He said, inflation, everything that I buy goes up, everything that I earn goes down. So that is the best definition of inflation, because that's the problem when they calculate inflation, is that it doesn't matter, for example, that they say, there's very little increase in prices of consumer goods in the Eurozone, for example, when you see after the crisis that real wages were down significantly. So that is inflation.
Some of it is a supply chain disruption. Some of it is. And what's interesting to me is a lot of the people, it's the typical hyperinflationist crowd. We don't need to name names, but they've been wrong forever, and they're going to be wrong on this one again. But those disruptions are going to wear off. But also government policy is counterproductive. Look at Biden, for example, raising of all things lumber tariffs on lumber from Canada. Now, how crazy is that when the cost of building a home is the cost of the average home in the last year just for lumber has gone up $36,000. Now, lumber prices are crashing right now. Hopefully they come back down all the way. But you had this hoarding of supplies. There's always these shortages at the top. There was this alleged shortage of housing in 2007.
Yeah.
And there's an alleged shortage of houses again right now. We
Yeah.
don't have enough houses. There's not enough houses. This is what happens when the Fed overstimulates demands for certain segments of the economy by policies that they ought not be leveraging in at all. They've
Yeah.
suppressed rates on mortgages, artificially increasing the demand for houses, and houses are going up, and people see that houses are going up, and so they get this idea, we better buy now before it's too late, or we'll never be able to afford a house. And that's what's fueling this housing bubble right now, and yet people don't see it.
Yeah, no, what, you know, one of the things that we keep saying is that after a sugar high comes a sugar low, and that risk is very evident when you put together three effects at the same time: the monetary stimulus, the massive fiscal stimulus, with the reopening of the economy. It generates elevated inflation from the goods and services, where the marginal pricing is more impacted. But it's interesting to see, for example, how in aluminium and other areas where there's massive overcapacity, prices are going up as well, which is the monetary effect. No, so I think that those two elements generate that problem. Is that on the one side, prices go up very fast because of the reopening, and on the other side you have the monetary impact of the reduction in the purchasing power of the currency. One of the we're going to wrap it up right now because we're having a great conversation, but I wanted to wrap it up with the three things that you believe investors should be looking at in the next 6 months as in order to see how all these things that we've been talking develop. What are the three things that you would pay most attention to?
I'm not sure that 6 months is a long enough time frame. It might be, but
well, I mean, 1
year. I'm going to say that the long bond yield has things right now.
Yeah.
So yields are coming down. I think that's a sign of slowing growth. I think we can look for that in fourth quarter GDP and first quarter of next year. That's going to underperform what's going to happen. I think we've had this temporary sell-off in gold here on this notion that the Fed is going to start hiking sometime sooner than what anyone thought, blah, blah, blah. I'll be surprised if they hike at all. Yet I'm wondering how they can possibly cut from here. So there is no lower here. If they don't get a hike in, they can't cut at all, because I don't think they're going to take interest rates negative. I think you just have to be mindful that at any time bubbles can pop. So I like gold. I think for now, I think long dated treasuries are going to rate to perform pretty well. And I've been wrong for years about where the stock markets can go. So maybe I shouldn't offer an opinion, but there's a clear bubble there, Daniel.
Absolutely. Well, I think that, what people need to do when they're looking at the stock market right now is certainly be aware of the elevated valuations, and then decide which sectors they might like. We still think that there's some value in some sectors and in some countries, particularly in the United States, actually. And but we have to be mindful about the very elevated valuations in some areas. No, Mish, it's been fantastic to talk with you. I have a lot of things that I'm taking out of this conversation, things that definitely make us think, and I'm sure that our viewers as well. Remember that you have all of the details to follow Mish here in the description of the video below. And what can I say? Great to talk to you. Look forward to talk to you soon in the near future. And have a great day. Thank you so much for this.
It's been a lot of fun, Daniel. I appreciate inviting me. I think we expressed some things here pretty clearly, and it's up for the market to see if it agrees with us or not. I believe it will. People can follow me at mishtalk.com. I'm Mish GEA on Twitter. So please subscribe to my feeds. Thank you very much, Daniel.
Thank you.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.